This segment sponsored by Foster Financial. It's a new week, so it's time for a new Money Monday with Foster Financial. And today I'm going to speak with Caleb Doan about some interesting things that's happening in the financial market and important things for you to know. Hello, Caleb.
Hi.
How are you?
I'm doing well. How are you doing?
Good, doing well. Okay, so today we're going to talk about end of year planning because I cannot believe it. We are already in October.
Yeah.
Like what? 3 months left of the year. And so how can people start to plan, and what specifically should they be looking for?
So we're in the fourth quarter of the year, so everyone's starting to think about what needs to be done by the end of the year. There's certain things when it comes to finance that you kind of get until you file taxes.
Yeah.
That is kind of the deadline, so maybe April of next year. There's a lot of things that have to be done by the end of the calendar year. Roth conversions are one of those things that need to be done by the end of the calendar year if you want it to count for 2025. And I don't think we've talked about these in a little while, but Roth conversions is basically when you take money that's pre-tax, so it hasn't been taxed yet. Oftentimes most of the money in somebody's 401k or all of the money in somebody's IRA typically is pre-tax. A Roth conversion would be taking some of that money, moving it over into a Roth IRA. When you move it over, it becomes taxable in the year that you move it over. So oftentimes we'll either withhold money for taxes or we'll send in certain tax payments. And then it goes into the Roth account. And once it's in the Roth account, it can grow and be withdrawn completely tax-free for the rest of your life, as long as certain stipulations are met. But that's one of the things that we do with Roth conversions. A lot of times we're doing that because someone might be in an attractive tax bracket right now, and we calculate how much room they have until the top of that tax bracket, and we say, all right, we're going to do this much in a Roth conversion this year, keep you in the same tax bracket, pay the taxes on that money so that we don't get hit with taxes down the road.
Okay, cool. Okay, let's break down a couple of things. So you say that someone could be in an attractive tax bracket. I'm like, hey, tax bracket, how you doing?
Exactly.
What is an attractive tax bracket?
Yeah, basically, you're in an attractive tax bracket if we think that maybe later you're going to be in a higher tax bracket.
Like you're in a
lower tax bracket right now. Yeah, and that can happen for a lot of reasons. A lot of times, right when somebody retires, they might be in a lower tax bracket because they no longer have that W-2 income that they were previously getting, and maybe they're just taking some withdrawals from their investment accounts or cash accounts to live off of. And so they might have gone from the 22% tax bracket all the way down to the 12% tax bracket. And it might feel good while you're in there, but you might not be using all the room that you have in that 12% tax bracket. Later on in retirement, either when somebody starts RMDs, or maybe if somebody goes into a nursing facility, or maybe if a spouse passes away, those are all common circumstances where somebody's tax bracket might get shot back up. And so instead of waiting for that to happen, we can do these Roth conversions in the meantime, pay the taxes in a lower known tax bracket right now, and then the taxes are fully paid on that money. Things that reduce your taxable income would be like, if you retire and you no longer have that W-2 income, or maybe you had a part-time job and that drops off. Maybe you had a pension that was only paying out for a certain number of years, 10 years or something like that, and then that stops. Deferred compensation, maybe that gets paid out for a certain period of time and then it stops. There's a lot of things that could cause your tax brackets to lower. The main thing that we do is we look at what tax bracket you're in right now, and then we project out what tax bracket we think you're going to be in the future. And again, that might be increasing for a variety of reasons, but especially if we think you're going to be in a higher tax bracket in the future, let's pay the taxes right now on at least a portion of that money. And so we calculate ahead of time what we think your taxable income is going to be and factor in everything that we talked about. Also factor in, standard deduction versus itemizing. This year we start to get what's called that senior bonus with that new legislation that Trump recently signed into law. That will affect somebody's taxable income.
Remind us about that?
Yeah, that's that extra $6,000 deduction that people over the age of 65 65 are getting if their income is in certain kind of ranges. And so that will reduce your taxable income. So that might actually give you more room in your current tax bracket to do more Roth conversions this year. And that's only for a couple years too, that extra senior bonus.
And what is the, and I know this is off the top, but what is the income range?
Bracket? For someone as a single filer, it's $75,000 or under, you get that full $6,000 deduction. For married filing jointly, it's $150,000 or under, you get that full $6,000
and this
senior
starts
bonus.
On the next filing?
Yeah. So for 2025, you'll be filing in April 2026 for this. And if you're over those limits, that $6,000 deduction just starts to be reduced and fully phases out $100,000 over the start of that limit. But all that to say, I mean, that gives you more room in the tax bracket. So maybe you could do a larger Roth conversion this year. Or if you've never done a Roth conversion, maybe this is a good year to start.
See, and that makes me think about a question. Is a Roth conversion something that people do once a year at the end of the year, or do they do it like once in a decade or once in a lifetime? Like, how often are people rolling over their funds into a Roth?
Yeah, that's a great question. Oftentimes, we're doing it once every year for a certain period of time. It can be done at the beginning of the year, the end of the year. We tend to do it more towards the end of the year just because we have a better idea of projecting what your income is going to be. So we have a more concrete idea of what your taxable income is going to be and what the room in that bracket is. But oftentimes, people are in maybe a lower tax bracket for several years, where we see they retire at 65, their RMDs don't start until 73. So there's 8 years there where maybe we're in a lower tax bracket than what we'll be in for the rest of retirement. So we'll do a conversion every single year for those 8 years.
Okay. All right, good stuff, a lot of stuff. Again, this is why they need to come see you, so you can break it all down and see where they qualify, and also get reminders like that senior tax. You know, you get those little nuggets because you know about it.
Yeah, absolutely. We're happy to help.
Yeah, thanks, Caleb.
Thank you.
And if you would like more information about Foster Financial, we'll have their phone number listed below. Make an appointment. They give you fresh baked cookies when you come in, and really discuss your financial planning because it's so important. And I'll see you after the break. This segment sponsored by Foster Financial.